Welcome to TechReg 360, brought to you by the University of Hong Kong's RegTech Lab. TechReg 360 is a discussion platform born of the HKU fintech ecosystem with the aim of highlighting current issues, analyses, and recommendations from global leaders on fintech, regulation, and sustainability. TechReg 360, framing the future and building bridges. My name is Jay Shambasani, and I'll be your host and moderator today. And our discussion topic today is a report entitled Wanted, a Prudential Framework for Crypto Assets. We'll be speaking with the authors of the report. Lee Reiners is the policy director at the Duke Financial Economics Center and a lecturing fellow at Duke University Law School. Sangita Gazi is a third-year doctoral student at HKU's Faculty of Law. The collapse of the cryptocurrency exchange FTX November 22 is the most significant moment in cryptocurrency history. While many commentators referred to FTX failure as crypto's Lehman moment, the fallout was largely contained within the cryptocurrency ecosystem, and there was minimal spillover into the traditional financial system. The authors argue that limited interconnections between the crypto ecosystem and the traditional financial system is the principal reason FTX's fallout was limited. The outcome is partially due, they say, to coordinated actions of federal bank regulators, each of whom had outstanding guidance in place at the time FTX failed, expressing concerns over banks' abilities to engage in crypto asset activities in a safe and sound manner, and ultimately requiring banks to notify the appropriate regulators before engaging in such activities. Their article assesses the adequacy of the Basel Committee's on banking supervision's final prudential standard for crypto asset exposures issued in December of last year, and finds that the standard fails to adequately address the unique risks various crypto asset activities pose to banks. They conclude by offering recommendations for U.S. bank regulators that can be quickly implemented to dimension the scale of banks' crypto asset exposures and mitigate the associated risk. And with that, Lee Reiners, Sangita Gazi, thank you for joining us.
Thanks for having us.
Yeah, it's great to be here. Thanks for having us.
Much obliged. No, this is for sure a topical and timely issue. And if you could sum up your central argument of your paper and any relevant policy prescriptions you'd care to make, that'd be helpful.
Sure. So, Jay, I think you did a good job in kind of summarizing our paper and the issues that we grapple with. But, going back to the FTX collapse, last November, we really dodged a bullet, right? The financial system, financial stability, really dodged a bullet. And part of that is due to what I consider to be prudent actions on, by bank regulators. But another part of that is just, sheer luck. Let's face it. And, at the time that FTX imploded, the market value of all cryptocurrencies was around $2 trillion. It had previously been at a $3 trillion market cap. And that was bigger than the value of subprime mortgages, before 2008. Yeah. So from a size standpoint, right, it could have been a systemic risk event, but it wasn't. And the reason it wasn't was because at that point, crypto had limited interconnections with the regulated financial system, the traditional financial system. And of course, the most regulated aspect of our financial system is banks, right? Banks fulfill a valuable function. They engage in, maturity transformation, liquidity transformation. And because that's an inherently unstable business model, banks are subject to very robust regulation. And so we saw the bank regulators in the US, and I'm sure many reviewers are aware that we have a real alphabet soup here when it comes to bank regulators and financial regulators in general. But you had the Office of the Comptroller of the Currency, which charters and regulates national banks. You had the Federal Deposit Insurance Corporation, which of course provides deposit insurance in the US. And then you had the Federal Reserve, which regulates bank holding companies as well as state chartered banks that are members of the Federal Reserve System. All these agencies had guidance in place that basically said, hey, if you're a bank that wants to engage in crypto asset activities, you need to first notify us and get permission from us. right? And so that's a strong signal that the regulators were sending to banks, that they are very skeptical about crypto and concerned that banks and have concerns that banks can do crypto activity in a safe and sound manner, right? Is the language that they use. So for that reason, you had a lot of banks who, in my opinion, chose not to get too involved in crypto, and that limited the spillover of FTX. What we go on to say in our paper, though, is that this, the status quo can't prevail, right? It can't be a policy forever, in our opinion, that bank agencies just basically say, hey, you need to get permission from us first before you do anything crypto related. Because as we'll probably talk about, there are a lot of different ways for banks to gain exposure to crypto assets. And so at some point in time, the bank agencies need to sit down and actually flesh out what we call a comprehensive prudential framework so that everyone knows, right, not only this is what banks are allowed to do when it comes to crypto, but if they do choose to pursue certain activities, this is what the capital treatment will be. This is what the liquidity treatment will be. So I think, where they're at now is okay while they kind of wrap their heads around the extent of banks' exposure to crypto and try to kind of parse through what happened with FTX and some of the other subsequent crypto failures and how that tied into the banking system. But at some point, there needs to be a coordinated response. And of course, that's why we have organizations like the, Basel Committee for Bank Supervision. But that's our kind of thesis, is that, hey, the status quo is okay for now, but ultimately, we need some more guidance here and more clarity from the bank regulators.
Okay. Sangita, would you like to chime in?
Sure. Definitely Professor Reiner sort of precisely highlighted the core argument of our paper. So another thing I would like to add, it's about the prudential regulatory aspect. So right now, status quo is fine, but at the same time, we try to critically analyze the status quo as well, because we have a framework which is supposed to be implemented by January 2025, and the treatment standards, like the way it was laid out in the framework, in our opinion, it's probably not adequate because it didn't capture the novel risks that are associated with crypto assets. We probably will be unfolding these aspects later on. Let's say infrastructure risk or some risks that are very inherent in crypto assets and which are not available in other forms of assets. So should we have a different standard, or should we have a comprehensive way to how should I say that? It's just the way this infrastructure or other risks are set out in the prudential regulatory framework, it did not adequately capture and the prospective risk. So we try to outline those arguments as well. It's also an initial conversation, and we probably will see what would be the nitty-gritty of those aspects. However, I think, in my personal opinion, the way it is now, the status quo probably is not enough.
It's crypto is not that new anymore. But from the standpoint of policymakers and regulators, this is still a relatively new, novel asset class. For many of them, it's still something of first impression. They haven't fully come to grips with it. And so necessarily, creating rules is going to be haphazard, at least for a time.
Yes, of course. There is no doubt on that. This asset class is still very new.
And it's volatile. It's a novel, volatile asset class. What are they to do with something? How do they even begin to think about something that's so inherently risky? Even though I know the two of you have the position that nothing is born risky, but it becomes risky over time.
In my opinion, when blockchain technology was in was in operation like in 2009, but it wasn't like famous until Satoshi Nakamoto proposed that paper. Initially, the idea was very good. Like, okay, we have this like subprime mortgage crisis. Banks were devils, so we need to have something that is not bank. The problem started when this crypto, which was supposed to be an alternative financial instrument, sort of like should operate as opposed to banks. When the problem occurs when this traditional financial system started like adopting this as like as an asset, and it's sort of like a profitable, like, because that you don't have a regulated market, the spot market is not regulated, and then you're having like all those like derivative instruments, and you have this like ICOs boom, and lots of like scams and cyber hacks. All the exchanges were like so prone to like some sort of like threats of like cyber hacks, and then tons and tons anyway. So these were happening at a small scale, and obviously regulators were not very aware of it because everything was happening I would say like bypassing the traditional financial system. However, consumer were like losing a lot of money, and it was happening like since 2013, 14. And how the main issue here becomes like how cryptocurrency operates. Number one, we have like a novel technology called blockchain that does operate differently than any other traditional technologies. But then again, there are like a lot of technologies. So it's not like blockchain is something, it's very unique, but it becomes unique. The risk becomes unique because of like all the aspects that would kind of like help other people bypass the regulation and create some sort of like a risky asset, and making like consumers susceptible to those kind of risk. So for example, in the Prudential regulatory framework, I mentioned that they talked about the infrastructure risk, which is very true for crypto assets because of their very nature of the technology, like let's say blockchain or DLT, distributed ledger technologies, and the way it operates. Regulators are still like sort of like figuring out. However, the main issue becomes when they say that like infrastructure risk should be like eliminated, or it should be valued or assessed by the banking institutions itself, not giving any sort of like standard guidelines for them, like what do you mean by infrastructure risk, or how should banks evaluate this infrastructure risk. It becomes like more riskier because we know that traditional financial system somehow, obviously it's my personal opinion, they try to engineer something that would definitely bypass the regulatory orbit. So should we just like leave everything on the discretion of the banks, or should this international supervisory organization give some sort of guidelines that would hold banks accountable? So that's something that we are trying to figure out.
Yeah. And just to add to that, I mean, it's a fair question, Jay. And and listen, obviously, financial regulators are always a step or two behind technology, and I think when it comes to crypto, they're probably more like 10 steps behind. And I think there's a credible argument to be made that crypto should have no place whatsoever within the regulated banking system, because crypto is untethered from the productive purposes of finance. Right. I mean, you just think of securities, right? Securities are so that's
coming from basically.
Yeah, right. So that's the perennial question, right? Which is, why is Bitcoin worth $20,000 and not $5 and not $10 million, right? Or worth anything at all. And so given that volatility, that I totally agree that it has no inherent value. Now, obviously, people disagree with me on that point. You could say, listen, shouldn't be involved in the banking system at all. Okay, fair point. And I would actually say, like, banks should not be allowed to hold crypto as a principal, right? Meaning a bank should not be allowed to invest in Bitcoin or Ether or, some other token, in my opinion. Okay, so that's fair because it's just too volatile. But crypto is legal, right? In most jurisdictions. Does a crypto exchange have a right to a banking account, a transaction account? They have to make payroll. They have to pay their vendors. I think we would all say, yes, as long as it's legal, they have a right to banking services. What about custody, right? We know that crypto custody is a big issue. And there's this adage in crypto, not your keys, not your coins, right? You send a transaction by signing it with your private key, an alphanumeric string of characters. There's a lot of issues with custody right now. Most people buy crypto and hold it, and custody it at an exchange, like Coinbase or Binance or what have you. Well, historically, that's been a role that banks have played as a custodian function. Okay, so, people are going to buy crypto. It needs to be custodied somewhere. Most people aren't going to self-custody, right? Because there are a lot of risk involved with that. So should banks be allowed to provide custodial services for crypto? What about the fact that we have crypto derivatives? For instance, in the US, we have cash settled Bitcoin futures contracts, right? Where because they're cash settled, Bitcoin never is involved in the transaction at all, right? You just have a contract price and then you settle up in dollars based upon the difference between, the spot price at the end of the contract and the contract price. Yeah. Well, does that mean that, banks with, broker dealer affiliates, shouldn't be allowed to offer those products to their customers, even though it trades on the Chicago Mercantile Exchange? What about stable coins? Right. We know that, stable coins are used widely in crypto because it provides this, the anecdote to crypto's volatility. More crypto is bought and sold using stable coins than fiat currency. Well, most of these stable coins maintain their value by holding, a reserve of assets in the form of, treasury securities or cash, right? So should banks not be allowed to hold and deposit the reserves of stablecoin issuers? So when you actually drill down, it's a lot thornier than when you just look at a high level and say, oh, crypto's so risky, it's so volatile, it shouldn't be allowed in the banking system at all. Okay, I understand that sentiment, but this is an industry. There are real businesses. It's legal. It's not going away. Most jurisdictions aren't going to ban it. And so what should banks' role be in this, and what kind of guidance can the bank regulators give so that everyone has a bit more clarity, right, around what banks are allowed to do, right, and then the prudential treatment, capital, liquidity, and that's kind of what we're arguing for, and what I think will ultimately end up happening. It just might be slow going.
That's right. This segues nicely into the next point then, about your call for a holistic approach, that the Basel Committee's approach to liquidity has holes in it. Could you elaborate? And I mean, I get a corollary to that is, should there be separate prudential regulation for crypto again, while acknowledging that it's an emerging asset class. It's not as established as other asset classes. So people are still trying to figure out what the contours should be. But yeah, be keen to hear your thoughts.
Yeah, I mean, so I'm a kind of a believer in the precautionary principle, meaning that when regulators kind of aren't quite sure of how big the risk can be, that they should proceed as though the risk is significant and regulate accordingly. And I think that's the right approach to take to crypto assets. There was a couple of interesting developments post FTX that I think shed some helpful insights on this broader debate that we're having. And that is, we saw a couple of banks that had sort of fell through the cracks, so to speak, and were actually pretty heavily exposed to crypto. And I think that just is emblematic of kind of the weaknesses in this sort of ad hoc approach. Hey, get permission from us, let us know, first. So the examples are, so it's Silvergate, Moonstone Bank, and then Signature Bank. And so I think, Signature Bank is probably the one that's worth highlighting here, because that's the third largest bank failure in U.S. history. So they failed. So, SVB was technically failed on a Friday, Silicon Valley Bank. And they had some modest crypto exposure as well. It's not what brought them down. And then kind of the spotlight turned to Signature Bank, and they had, pretty significant crypto exposure, and they experienced a run. And, in my opinion, at least, a big reason why they ran was because of that crypto exposure. And this is something that we actually draw out in the paper. Is it even possible for a bank to have any type of crypto exposure and not have these kind of run dynamics, in the sense that when the crypto markets get skittish, as they tend to do, right? People look at various banks and say, "Oh my God, they're exposed to crypto. Let's get our money out."
Yeah.
So that was a real issue. Now, again, if you listen to the New York State regulator, they're saying that, crypto is not what brought Signature Bank down, but it certainly played a big role. And so, again, going back to the Basel guidance, really all that's looking at is exposure on the asset side for the most part. But it's not taking a look at, for instance, we have liquidity rules. And so we have things like the liquidity coverage ratio and the net stable funding ratio. So the liquidity coverage ratio is designed so that banks can meet a 30-day stressed outflow event. They have enough high quality liquid assets on hand to meet, a modeled stress outflow. Okay, so what should be the outflow rate then for deposits provided by crypto firms? Okay, because we know that crypto is volatile. That means if there can be a run on crypto businesses, that means there can be a run on banks that are exposed to crypto. So this is something that the Basel Committee is completely silent on, because it's, again, only looking at exposure on the asset side. So I think this is something that regulators need to go back to the drawing board on and think of all the ways
Very myopic.
in which banks can.
It's
Exactly, right. So, okay, you hold, you hold a stable coin on your balance sheet, for instance, or you hold, Ether on your balance sheet, for instance. We're going to attach, a very high risk weight for that. Okay, fine. That's historically how you've done it, right? Obviously, the whole point of risk weights is the riskier the asset, right? The more capital you have to hold against it. But as we talked about, there are many ways for banks to be exposed to crypto. And I think it's pretty clear that those exposures are not the same level of risk as exposures to established businesses. And on the liquidity outflow side, I think that's a perfect example of where they need to go back to the drawing board and figure this out.
Certainly thresholds would help. I mean, look, years ago, when I studied futures regulation, I had a prof who he'd worked in the pits, he'd worked at the CME, he'd worked at the Board of Trade. And the conclusion he'd come to was the futures markets are a great way to build wealth. But he cautioned us, you got to be cognizant of the suitability requirements, and futures had no suitability requirements because if you, unlike in the securities context, because if you applied those suitability requirements, even Warren Buffett wouldn't qualify.
That's a great point, because that suitability, issue did arise when we saw the introduction of Bitcoin futures in 2017. I mean, so if folks don't remember, 2017 was kind of the first Bitcoin bull market run. Okay. And there have been a couple since then, but, basically started the year, a couple $100. It ended the year, mid-December, it peaked at around $20,000. Okay. So the December, right before it peaked, is when these futures contracts came to market. And you saw this interesting backlash from legacy institutions against the introduction of these products. One of the reasons was because of the suitability concern, right? You had firms like JP Morgan.
That is rich.
You had firms like JP Morgan saying, we are not going to offer our clients these products because we just don't envision a world in which they'd be suitable. Now, they've all changed their tune on that front. Okay. But another concern they had was because these would be centrally cleared, and these futures commission merchants, right? They're the ones that stand between the people placing the orders and where they're executed and cleared. They're all members of these clearinghouses, and they were worried that should someone default on their Bitcoin futures position, that they, as a futures commission merchant, would be on the hook, right, for covering that. It would basically exhaust the clearinghouse's existing resources, and then essentially the hat would be passed around to all the futures commission merchants, right, to ask to make the counterparties whole, even though some of them have refused not to offer these products. So again, it's like everything is in crypto is like, all the old debates in finance have been played out again and again in crypto, but it's an apt. I'm glad you brought that up.
The three banks, Silvergate, Silicon Valley, it becomes a situation where it's guilt by association, it's taint by association.
That's right.
Crypto still has a certain stigma, and it's in that environment that the do somethingism attitude kicks in, especially when enough people lose money, and regulators start to act out of fear.
We talked about this in our paper. The reputation risk of crypto is much, much higher than any other asset classes. So whether crypto should be a different asset class, or should we regulate it as a security or commodity, lots of debates are going on. In my personal opinion, it is something novel, and that should be treated as a separate asset class. And I know, we have the tendency of regulating something which is obviously we do not want to have a lot of regulations, right? If an existing regulation can capture the risk and can regulate it, so why not use the same thing that we have? However, my personal opinion, and the opinions will vary, the crypto should need a separate sort of regulation because of all the risk that are associated with it, the reputation risk, the infrastructure risk, and this market volatility. We do not have any price cost structure, so it should be treated as a different asset class. And if we treat them as a separate asset class, then the organization or the entities that are dealing with cryptos, it's just not only FTX or centralized cryptocurrency exchanges. There are a lot of DeFis as well. And if you look at these DeFis and how they decentralized finance operate and their liquidity requirements, it's all vague, and people in general, they do not understand it. They just understand okay, Bitcoin is $20,000. I just buy some Bitcoins. Oh, Bitcoin is down now. I'm just gonna liquidate Bitcoins and buy something else. So
the bandwagon effect, the fear of missing out, that is so, the herd mentality, whatever you want to call it, is so powerful in markets. It's been that way for centuries. I don't know that if you can really eradicate the human impulse for greed and to make a quick buck, because people are seeing, say in places like Dubai, there are literally families that have brought themselves out of poverty into the ranks of the middle class, or gone from middle class to upper middle class or the ranks of the wealthy, on the back of crypto. Yeah, now, I have to remind people, so much of this is a function of luck and good timing, not their own personal judgment.
Yeah.
Well, so on that, I'll turn it back to Sangita, but on that point briefly, there's a lot of evidence at this point that's very clear that most people who've invested in crypto have lost money. And those who
depends when you got in, but yeah, most people come in an up market. So that's true.
So the BIS has put data out there on this point. The people who have made money are were early, and we're fairly technologically sophisticated, including a lot of venture capital firms. But yeah, sorry, I just wanted to put that on the record, because far more people have lost on crypto.
So the people who are now dealing with the blockchain technology, and in one of my papers, I had the opportunity to look at the centralization aspect of blockchain technology, because we say that it is a decentralized technology. So people, like, there's no common what is it called, like a centralized party that is controlling this aspect, which is not true. So even if you look at this like mining operation, like mining pools of bitcoins and ether, only like there are like few big companies or firms who are holding this cryptocurrency. So the centralization aspect of it is very like misconceived, and people perceive it like the perception is sort of like wrong. However, the data probably, or we do not have like enough evidence, or maybe people, hard mentality will always be there. But at the same time, the question becomes like, can regulator just like ignore this? My answer would be like no, because we already have like enough evidence that crypto can be very risky. People have lost money, and not only that, like these cryptocurrency exchanges like FTX, Celsius, Genesis, the bankruptcy cases that are going on. I mean, everything is a public information, and they never maintained any liquidity standard. They don't have any standardized accounting method. Their balance sheets were like all vague. So, and people probably, I don't know, like not everybody wants to just like read about like, okay, what kind of like standards they're using. They just know like, okay, it's sort of like, okay, it's showing like good money, and I'm just gonna pay some bucks and I'm gonna liquidate later. So that's how like everything's happening at the same time. Yes, this is probably like too early for us to say, and all the assets probably go through that kind of like volatile stage. However, I think we are at that point where we should not say that it's just like a novel and everybody is figuring out. We do have, although we are saying that there's no enough evidence, but at the same time, we also have like a lot of evidence that show that like these assets need to be regulated properly. And the prudential regulatory treatments should be laid out so that like they can capture like the novel risks that are associated with these assets.
I want to come back to FTX. Your position, from what I gather, is that while the FTX case was bad for crypto, it was not bad for the financial system or even the broader economy, that it doesn't rise to the level of a systemic risk on a par with the subprime crisis of 2008 that led to the global financial crisis, because crypto is not fully integrated into the broader banking and financial system, either in the US or globally. And so if we were to say something in praise of the regulators, which I believe you do, I mean, as bad as the case was, it could have been worse, and it would, in some sense, it could be seen as a policy success, because it didn't happen by happenstance. It happened because you had very, adroit, acute regulators who were on top of their game, who had guidance that enabled them to act in the event of a contingency, which did occur.
Yeah, I mean, certainly, at least in the U.S., that's the case. And of course, the U.S. is the largest financial market in the world. So I think kind of what we do here, drives the systemic riskiness, if you will, throughout the globe. But I mean, obviously, our paper is focused on the role of bank regulators and bank exposure to crypto. But I do think other regulatory agencies deserve some credit, one being the Securities and Exchange Commission here in the US. Now, of course, the crypto industry would vigorously disagree with me, on that point, but their stance, and this goes back to the chairmanship of Jay Clayton, who was the chair prior to the current chair, Gary Gensler, and Jay Clayton was Republican, by the way, and their stance has basically been, look, most cryptocurrencies are securities. And therefore, they need to be registered with the U.S. They need to be registered with the SEC, and they need to, follow, disclosure rules. And so the industry, in my opinion, has willfully chosen, for the most part, not to comply with that. But it's also, I think, limited their reach because of that. And, the SEC has also said no, for instance, to a spot Bitcoin ETF, right? Which is for a lot of folks, it's in crypto, it's kind of like, getting an ETF is like the holy grail, they'll really made it somehow if they could get a spot ETF. Now there are ETFs on Bitcoin futures.
Well, that's
right?
a license. That's a license to mint money. You've got the perimeter of approval. Yeah, I mean
that's right. That's right. And listen, obviously most we're all familiar with ETFs, right? Even your average retail trader is familiar with ETFs. It's a very liquid structure. It's a structure that people are familiar with or comfortable with. And so that would really, I think, give a lot of legitimacy, unearned, in my opinion, to crypto if they were to have an actual crypto ETF, and the industry suing the SEC to get that. So I think that's another example of regulator holding firm. Another here, and this is in the U.S., and this one is less well understood and appreciated, is the role of the Department of Labor. Believe it or not, and the Department of Labor oversees. When it comes to the Department of Labor oversees employer-sponsored retirement plans. So things like your 401k, for instance. And so you had, in 2021, Fidelity, which is the largest 401k administrator, retirement plan administrator in the U.S., say that they were going to start offering Bitcoin in their investment plan options. Which to me was like crazy. I mean, it's like offering like lottery tickets in your 401k plan. And you had the Department of Labor say, wait, hold on. And they issued a letter saying that, they think it's in essence a per se fiduciary duty violation to offer these products. And that really slowed the rollout of what Fidelity was trying to do. And I'm sure there would have been more behind them. So we really did luck out, but, I think, again, these examples highlight the old adage that personnel is policy, right? Because this is just guidance. All this stuff, by and large, is just guidance. And the thing about guidance is that it can be undone, and guidance has been undone, right? These are essentially just existing regulatory agencies saying, hey, based upon our read of the law, this is what we think. But you could have new people come in, a new administration, and say, you know what, we kind of interpret it differently, and allow banks to engage in whatever type of crypto activity they want, and allow 401 plan sponsors and administrators to offer crypto, and give approval for a crypto ETF. There's nothing stopping, those events from happening in the future. And so, I mean, that's a bit scary, but I mean, it's a necessary, byproduct of a democratic process, right? I mean, financial regulation, is political because it's influenced by political choices.
And there's certainly a school of thought that says, if given a choice, the crypto world would prefer to be regulated by the CFTC than the SEC.
Oh yeah, I mean, for sure. This is what Sam Bankman-Fried was pushing for the hardest, and there's a variety of reasons for that. I mean, listen, we're in the midst of a roiling debate here in the U.S. around how to regulate crypto. Is it a commodity? Is it a security? Is it something else? Should we regulate it like gambling? And our paper is indifferent to that issue. Not that I'm indifferent to it personally. I'm on record, testified in Congress twice saying that, Congress should say, listen, all crypto is a security. Let's end this debate once and for all. So that's my view. But, again, regardless of how that debate concludes, banks are going to be exposed. Okay. One way or the other. They are exposed now, and they will continue to be exposed. And so that's why we need the banking agencies to come together, right, at the international level and think through this and flesh out a comprehensive framework, and there's gonna and they play on one another too, depending on the outcome. Is it a commodity? Is it a security? Right? Like that's going to influence, the banking agencies. And we talk about this in our paper is again, custody, right? Because the SEC, the staff came out last year with what they call a staff accounting bulletin, SAB 121, that says if you're an SEC registrant and you're holding crypto in custody, you actually have to report that on your balance sheet as a liability and then an offsetting asset, right. Which is very different than how normal custodial functions are. Those are normally off balance sheet because they're not the custodian's assets or someone else's assets. But the SEC's point is that crypto it has unique properties that make it such that investors would want to know if you have this exposure, if you're providing custody. Therefore, it needs to be on your balance sheet. And there are reputational, legal risk, operational risk associated with that as well. Okay, so if that's the case, bringing it back into the realm of bank regulation, well, if it's on your balance sheet, guess what? You have to hold capital against it, right? And which is, again, very different. And that's going to make it, of course, cost prohibitive. And you've already seen this because you have the world's largest custodian, Bank of New York Mellon, who's gotten into crypto and who's provided crypto custody. And they're saying, like, listen, like, this capital treatment is killing us. And I'm sure it's keeping a lot of other banks on the sidelines. And so I think from a policy standpoint, again, crypto's legal. People don't want to self-custody. These assets need to be custodied somewhere. Should we want them to be custodied in the banking system? And should we be punishing banks by forcing them to hold more capital by providing a function that they've historically offered and not be required to hold capital against? So, these are all debates that need to be had and discussions that need to be had. And it shows how what one agency does can influence another agencies, right?
So would it be fair to say then that the solution you advocate is the global banking community come together and agree on harmonized rules the way they do with, say, the ISDA master agreement or, securities or futures or swaps, something akin to the SWIFT Accords? Is that the direction you see things going in?
Well, I think we already have a venue to do it. It's called the Basel Committee, right? I mean, we shouldn't leave it to because the banks, it's interesting because the trajectory we've been on here with crypto, which, of course, one of the ironies is that it was created to bypass the banking system. And yet, here we are where the industry is, clamoring for access to the banking system. In some cases, crypto firms actually want to become banks themselves. And along with that trajectory, you've had, traditional banks who, wouldn't touch crypto with a 10-foot pole for, the first, 5 to 8 years, let's say. But guess what? They've been seeing people make money hand over fist. And it's the old adage during a gold rush, right? You want to sell picks and shovels, right? And so, banks can see themselves as purveyors of picks and shovels in this crypto gold rush. And so if we let the banks themselves come together as an industry and kind of flesh out, what should be this framework, there, of course, it's not going to be an optimal outcome from a societal regulatory standpoint, right? So, we have the Basel Committee, for a reason. They do have a prudential framework in place. Again, we call out some of its weaknesses. It's very clear if you look at the revisions that were made, and there was an iterative process. They came out with 2 consultative documents prior to finalizing their framework last December. They're watered down. Each version was watered down, I'm sure because of intense pressure from.
It was roundly criticized at the time. I mean, if you recall the coverage, all the major financial news networks. Yeah.
Yeah. So, I think, again, the collapse of FTX is like, all right, let's go back to the drawing board here, Basel Committee. And of course, the Basel Committee's got its flaws. But it's kind of the best thing we have, right? Rather than try to invent something from scratch, like let's, use the Basel Committee, as imperfect as it may be.
Akin to the UN. Yeah, for sure.
I want to add just one thing. Yeah. If you look at the prudential regulatory framework of crypto assets, as it stands now, the way Basel recommended that even though banks can be exposed to crypto assets, they cannot use these crypto assets to make loans, so they cannot be collateral. That actually sort of challenges the fundamental business models of banking institutions. Why should they have cryptos on their balance sheet and hold like these tight capital requirements or liquidity requirements if they cannot use it like to lend money or
akin to a non-performing asset. Yeah.
So it is like a sort of like, I mean, even though they relax some of the requirements and probably like maybe intense pressure from the other crypto firms, however, like this at the end of the day, it is not sustainable even for banks having like this tight capital requirements or prudential regular requirements and not being able to use that to lend money or to make credit. So even for banks, I guess like this exposure or the regulatory framework is not beneficial in future.
Something you stress in your paper, and this is the last point I have, is that of interconnectedness. That interconnectedness in and of itself is enough to create spillover effects, and therefore caution by banks is needed. At what point should the red flags be hoisted, though? At what point should banks say, okay, this is a situation's reached critical mass, action needs to be taken?
I think the banks will never, I mean, it's my personal opinion. I think banks are inherently, they have the tendency to engage in risky behavior. It's just right. The history, I mean, sort of like taught us. About the point of interconnectedness, I mean, right now we are probably focusing on the US jurisdiction, and that's our paper is based on the US jurisdiction. However, in different parts of the world, like United Kingdom and European Union, even Hong Kong and Singapore, they are trying to create a not harmonized, but a standard regulatory framework for crypto assets, and they probably want to be crypto hubs. Right. Once they have a standard regulatory framework and US, let's say like US, regardless of their state as a security commodity, if they have some sort of like unanimous regulatory framework, there will be more interconnected. The degree of interconnectedness would be much, much higher. We are going towards that. My personal, my understanding is that that doesn't make it less risky. I mean, the way it operates, the way we understand decentralization or like the degree of centralization of risk. And on top of that, like there are other risks like legal risk, operational risk, and the reputational risk as well. And obviously volatile market, all will be still there. So are we minimizing the risk? Or are we just like regulating for the sake of regulating? So those questions should be like answered first, because you need to minimize the inherent risk, and then regulation definitely will make it a safe asset for other investors or consumers to to participate in that. So this is like the way I understand about this regulatory framework of crypto assets. Nothing would be done until and unless the risks are minimized.
Okay. I want to shift gears real quickly before I give you the last word. There is a sense that with the Virtual Asset Regulatory Authority in Dubai, that it's a Wild West environment. They basically prostrated themselves for the industry, giving them whatever they want. And certainly post-2008, there's an argument that self-regulation, either explicit or functionally, means no regulation, and that is setting up a bad situation that people haven't quite countenanced. People are going to get burned by the uninitiated are for sure going to get burned. What are your thoughts?
Yeah, I agree with you. Sangita said, some of these jurisdictions, are clearly courting the industry and trying to become crypto hubs by providing, quote unquote, regulatory clarity. And I've always kind of viewed that call for regulatory clarity as a euphemism for we want light touch regulation. Basically, we want a different. We want rules, but we want a different set of rules that apply just to us and aren't as stringent as the rules that apply to traditional financial activities. And they've gotten that. for certain in some jurisdictions. I think personally they've gotten it with MiCA and the EU as well, and we'll see how that plays out. But this is a risk that these jurisdictions are taking, and we've seen how it's come back to bite some of them. Just look at the Bahamas, which rolled out the carpet for Sam Bankman-Fried and other crypto firms. And of course, now they have mud on their face. There was just a story today in the U.S. about how Coinbase, the largest crypto exchange here in the U.S., is looking to create a new subsidiary in Bermuda because they have provided regulatory clarity, and they're going to offer derivatives, crypto derivatives in that Bermuda subsidiary. So there's real risk involved to these jurisdictions if things go poorly. Again, I think Singapore is another example. They, I think, host, like Do Kwon and Terra was in Singapore for a while. It might have even had a license to operate there. So, I would just encourage, for policymakers that, are from around the world listening to this to just, proceed cautiously. And what I tell folks in the US is that, this is not a race. The important thing is to get it right, not to be first, because as you said before, Jay, financial regulation tends to only get implemented in the wake of some type of crisis, right? Because that's when you have the political capital to make changes, right? To go up against the financial lobby, in this case, the crypto lobby.
Only when the smoke clears and you assess.
Only when the smoke clears. So, we're going to get essentially just one bite at the apple here out of the gate. And that's going to be the rules that we're going to have to live with until that next crisis happens. And so, that's why I say you don't have to rush it. But you do have to get it right. And ultimately, I do think that it is possible for the interest of the crypto industry and policymakers and the public to be aligned, because crypto, of course, suffers from a trust deficit right now. Right? When the spokesperson for your industry is a 30-year-old living in his parents' basement on house arrest, right? That's not a good look. Right? When that's what most people think of your your industry. And so how do you overcome that? Right? How do you overcome that trust deficit? With meaningful regulation that gives consumers and investors assurances that they're afforded the same basic safeguards and protections in the crypto world that they've come to expect from the financial world.
People probably looked at him and said, okay, those tech bros must know something. Follow them.
Well, we've always we've idolized tech bros for a long time. And he hammed it up for sure, for the crowd, and was wooing policymakers in DC. That's for sure. But, this is a point that SEC Chairman Gary Gensler makes. The U.S. has the deepest, most liquid capital markets in the world for a reason. One of those is because they're regulated. And that means that investors have access to the information they need to make an informed capital allocation decision. And there's basic safeguards in place to protect them from, abuses, insider trading, manipulation, things like that. Until we have that level of protection in the crypto world, the average person just isn't going to want to get involved. They're not going to trust it, because we're just going to keep seeing story after story of the Sam Bankman-Frieds and the FTXs and the Celsiuses of the world just play out over and over again.
But in the time we've got left, is there anything you feel we didn't cover? Is there anything you'd like to say? Any final thoughts you'd like to leave the audience with?
I mean, it's a complex issue. Definitely, we tried our best to unfold some of the debates and some of the regulatory aspects of this cryptocurrency or crypto assets. On the point of interconnectedness, I would just like to mention one thing. We have to understand that this asset or currency doesn't have any border. So because of the technology involved in it, it can operate. I know in Bangladesh, I'm from Bangladesh. In Bangladesh, cryptocurrency is not legal. At the same time, I also know that people do have cryptocurrency. So because it has this kind of mechanism, like inherent mechanism that enables people to bypass regulation and legality, whatever. So on the point of interconnectedness, when the regulatory, every country is probably sort of like adopting some degree of they're trying to give some sort of a regulatory clarity. However, at the end of the day, the regulation should have some sort of like uniformity, some standards, and because of this, like the component of crypto assets like that can go like from one country to another country within like a few seconds, and they have the tendency of bypassing this regulation. So even though we are seeing whatever we are witnessing is like called regulatory fragmentation, but at some point we need to have some degree of agreement, like how we should regulate crypto assets. Maybe, you know, I don't know, like the future will tell. Maybe we can start with this prudential regulation first.
That's interesting. I can understand why, certainly in the developing world, certainly in South Asia, people may want to bypass the banks. And certainly large populations of young people, increasingly tech savvy. And the view is we can transact amongst ourselves.
And remittance is one point. I mean,
yeah.
I think a couple of years back, I wasn't even thinking about that. And I never had crypto in my life. So, but at the same time, I know like, because of the value that is attached to cryptos, and we value it against US dollar. So a lot of people use that to just transfer it cross-border. And it's easier for them. And if you have the chance to bypass regulation, why not? People will always look at their the profit aspect of it, definitely.
You know, crypto's not going away. You know, even if you're a skeptic like me who thinks it has no, you know, inherent value, I think time has proven that, you know, there's going to always be at least a core group of diehard true believers. I mean, I like to say that crypto has taken on, you know, religious elements, frankly, at this point in time.
Guerrilla warfare.
The thing about,
you may kill 95, you may kill 95 of them. 5 live to fight another day. Yeah.
That's right. And you know, the thing about religions is just rabidness. Well, and religions can last a long time, right? Yeah. As we've seen. And so, you know, we dodged a bullet, you know, with the FTX collapse. I mean, of course, it was devastating to millions of people who had money, you know, and still haven't gotten it back, you know, on the FTX platform, who had funds there, you know, but it wasn't a systemic risk event. You know, we can't guarantee that outcome. No one can guarantee that outcome the next time. Yeah. And again, you know, the banking, you know, the banking sector in particular, is sort of the most, you know, sacred of all, if you will. We'll stick with the religion metaphor here. And you know, the holiest of holies. And, you know, if there's a problem, and again, you know, SVB has highlighted this, right? If there's a problem in the banking sector, then we all have a problem, right? Then the financial system has a problem. Then the economy has a problem. So, you know, at a bare minimum, there's a lot of aspects to crypto regulation, the market regulation, money laundering, right? But we have banking regulators that, you know, they've been around a long time. They know what they're doing. We know banks are getting exposed to crypto, you know, more and more. Let's figure out, how do we treat this from a prudential standpoint? What's the capital? What's the liquidity treatment? What are you allowed to do? What aren't you allowed to do? That way we can provide some regulatory clarity here, but also ensure that we're maintaining the safety and soundness of the banking system.
That's a good place to end this. This is an ongoing discussion. I hope you'll come back and fill us in on further developments with the passage of enough time. Lee Reiners, Sangita, thank you for joining us.
Thank you so much. Thanks for having us.
Thank you. It was a pleasure.
And to our audience, thank you. Until next time.